My name is Guru Hariharan. I'm the CEO and founder of CommerceIQ. With respect to the economy, obviously we're seeing a lot of funding sort of dry out, and that's what we are hearing in the news. But let's take a double click into why this is happening. A lot of expectations started to get built up in terms of the digital growth that was supposed to happen. There's a good news and bad news in this. The bad news is that it did not sustain at the levels of 2020 to 2021. But the good news is it's actually not fallen down. It's sustained and gone back to the previous level of growth. But a lot of the funding that actually came in during the 2019, 2020, 2021 timeframe was because of the quantitative easing that most governments did, and the rates being super low. When the rates are low, then the expectations of future profits you can actually bet on, which is if I do a discounted cash flow and I see that a tech company is going to make a lot of profits in a few years, then that's still okay and much better than 0% that I'm getting from the Feds. So a lot of money in public markets moved into technology stock. But as soon as the Fed rates went up because of the inflation issues, and at that point, like the rate at which you had to deliver EBITDA was much higher, and hence a lot of that money went back into the stock markets, and there was essentially a drain in terms of number of capital available for technology companies. Right now, it is not a time to panic. If you are a founder who's just starting up, this has never been a better time. It usually takes about 2 to 3 years to find product market fit. Fantastic time to hunker down and start hacking and start building a startup. But if you are a company that is currently working on, that is already funded, great time to actually focus on efficiency metrics. That is, I would go back to the basics, not really focus on growth at any pace and just fund growth at all costs, but actually start to look at metrics like gross margin, cash flow, and burn multiple, and things like that. We at CommerceIQ have a mantra of efficient growth, not a growth at any pace. That is our best in class in terms of net dollar retention, gross profits, and cash efficiency. So that's what my recommendation would be. With respect to the budget that's coming up, India is sort of at a point where a lot of growth is going to be coming from technology, and there is a risk of the technology-driven growth slowing down. This is an opportunity for the government to actually put some influx, create some schemes, and create some programs for budding entrepreneurs, improving entrepreneurs way more than what they did in the earlier years, and probably way more than what is going to happen in 2 years. This is the time to essentially to bring in some more extra capital to fund the growth of the tech ecosystem in India. Another big area is essentially the work from home economy. Most tech companies are hiring workers who can work from home, which also opens up the ability to hire in remote places, in distant places, geographies, not just hiring in the metros, but actually hiring from second and third tier cities. If there are incentives that come to companies to do that, then it also creates a very good, fulfilling flywheel cycle for startups and other tech companies to be able to hire remote